Okay, what if I told you that one of the most widely condemned investment products out there might actually hold a hidden, long-term strategic advantage? Today, we are going to dive deep into the world of leveraged ETFs and pretty much question everything you thought you knew about them. Now, to understand why this conversation is so important, we just have to appreciate the sheer scale of the ETF market. I mean, look at this. 10 years ago, global assets in ETFs were sitting at around $2.9 trillion. Today, that number has absolutely exploded to nearly 14 trillion. These are not niche products anymore. They're a fundamental part of how the world invests. But inside this massive universe, there's one category that basically comes with a giant warning label: the leveraged ETF, or LETF. For years, the advice from academics, from financial experts, has been incredibly stark and consistent. It really just boils down to this simple phrase: just say no. And look, those warnings are there for some very, very good reasons, especially when it comes to holding these things long term. But what if that conventional wisdom, while totally well-intentioned, is based on using these complex tools in, well, the wrong way? What if new research is showing us another side to the story, a way to actually harness their power while managing their risk? This brings us to this really fascinating, kind of counterintuitive idea at the heart of this whole thing, what some are calling the call option advantage of leveraged ETFs. So first, a super quick refresher. A standard ETF, it just tries to match the return of an index. A leveraged ETF is built to deliver a multiple, say 2 or 3 times the daily return of that same index. And you really got to pay attention to that word daily. It's the source of pretty much all the controversy and, as it turns out, the hidden opportunity. And here they are, the classic criticisms. You've heard them before: volatility decay, time decay, weird compounding effects, higher expense ratios. It's because the fund has to rebalance every single day to maintain that leverage. That makes long-term performance really complicated. In a choppy sideways market, this can lead to that volatility decay, where the fund actually loses value, even if the index ends up right back where it started. So yeah, you can see why the warnings exist. But here is the one structural feature that changes the entire equation. The thing that often gets lost in all those warnings: limited liability. Just like any stock you buy, the absolute most you can lose is what you put in. The value can go to zero, sure, but it can never, ever go negative. And this right here is the key. So why is that protection such a game changer? Well, think about the old school way to get leverage. You'd borrow money on margin. In that world, a huge market crash could not only wipe out your investment, but it could leave you in debt to your broker. You could get a margin call forcing you to sell at the absolute worst possible time. An LETF completely eliminates that risk. The fund handles all the borrowing internally, so you get the upside without the terrifying danger of personal debt. Let's just look at the numbers here to make it real. In a rising market, yeah, both approaches give you great upside. But look what happens in a downturn. The difference is just stark. A 60% drop in the index could literally leave a margin investor in debt. The LETF investor, on the other hand, they lose their initial capital, but that's the end of the story. That's the limit. This combination, leveraged upside with a capped, non-negative downside, that is exactly what gives the LETF its call-like payoff. Okay, so if these products have this powerful built-in protection, how can they possibly be used over the long term? Well, the answer is definitely not a simple buy and hold strategy. No, it requires a completely different, much more active mindset. And let's be super clear here. All those classic warnings, they are 100% correct if you treat an LETF like a normal buy and hold investment. The research is emphatic on this. That approach just fails over time. To unlock the long-term potential, you need a dynamic, active rebalancing strategy. And it turns out sophisticated investors might already be onto this. When researchers dug through years of SEC filings, they found something really interesting. Institutional managers don't just sit on these funds. They actively trade them. And more specifically, they tend to decrease their holdings after observing strong recent investment performance. In other words, they sell into strength. So this insight is the basis for what the research calls a contrarian strategy. It works like this. You allocate a part of your portfolio to an LETF. Then, after the market has a great run and your position has grown a lot, you don't just let it ride. No, you rebalance. You sell off a portion, you lock in those leveraged gains, and you reduce your overall risk. You're systematically taking profits when things are going well. So, where does all this leave us? What is the ultimate strategic takeaway from this new way of looking at leveraged ETFs? It leaves us with this number, over 95%. What does that mean? Well, when researchers modeled this dynamic contrarian rebalancing strategy using historical data going all the way back to 1926, they found it would have outperformed its plain old unleveraged benchmark in over 95% of all rolling periods. That is staggering. Okay, let's just recap the big lessons here. First, LETFs can be a cheap way to add leverage to a portfolio while getting that all-important limited liability protection. Second, and this is crucial, they are a tactical tool, not a passive set-it-and-forget-it investment. The strategy is everything. Third, that strategy is fundamentally contrarian. You sell after big wins, which is the exact opposite of chasing hot returns. And finally, let's be real, this is not a free lunch. The risk of losing your entire investment in a crazy market crash is still very, very real. And all of this leads to a final, provocative thought. For decades, the entire conversation around LETFs has focused on their built-in dangers, like volatility decay. But maybe this research suggests a new perspective. Perhaps the biggest risk was never the tool itself, but a widespread misunderstanding of the sophisticated strategy you need to actually use it effectively.